Markets have shrugged off uncertainty so far this year, but with shifting yields, tariff pressures, and fresh signals from the Fed, the landscape is anything but settled. From the resilience of risk assets to the rise of defensive sectors and the latest moves in high-yield credit, there's plenty for investors to consider in the months ahead. We're going to break that all down for you right here on UBS Trending. Hello, everyone, and welcome to UBS Trending. I'm Anthony Pastore. Thanks for being here with me today. Leslie Falconio is back in the studio to break down the latest on everything going on within the fixed income landscape. So, Leslie, great to have you here. Always good to sit with you. Your July Fixed Income Strategist, which is the publication you release every month, it's about the second half outlook. What do you feel will be different in terms of rates, where we're headed, what's going on within the fixed income landscape as we look at the back half of the year, considering that there's been so much uncertainty and volatility up until this point?
Yeah, I mean, that's a great point. I mean, we have our second half outlook coming out in about the next week or so. But when you think about the first half of the year, what we've seen is that our expectation coming into the year, right, was that growth would slow, but we'd also continue with this disinflation trend, right? So we had, say, at the end of the first quarter, say 10-year Treasury yields would be about 4.25. Well, lo and behold, I mean, as we noticed, I mean, some of the sequencing of the administrative policies have come a little different than expected, with a little bit more depth, and the uncertainty that, as you mentioned, really skyrocketed. After the first quarter, we went down to that 4.25. We know we had Liberation Day, which set 10-year Treasury yields to about a 3.70, right? But then the market, sort of adjusted as the more knowledge or more certainty came with those tariffs. Left tail risk started to really sort of, lower, and we decided and the market was really kind of felt a little bit more comfortable, I should say. So when we think about how the fixed income has performed, the difficulty within the asset class has been positioning on the yield curve.
Right.
And what I mean by that, Anthony, is that because we've had sort of this push and pull between growth and inflation, you've had like this differentiation of what's the Fed going to do, are we going to have a stagflation, is inflation going to reignite? And the market has been pricing back and forth on every number as to what the Fed policy path will be. Well, luckily, we've had this situation where returns have really been very strong in fixed income mostly, but it's really been where you've been on the curve. But one thing that hasn't differentiated, and we see this in the chart right now, is that the yields are very good in fixed income, right? The compounding income has been very good. So our second half of the year outlook, and I have to admit, is not going to be spread compression, is not, as we sit at a 4.30 10-year Treasury yield today, our end of year 10-year Treasury yield is only 4%. It's not going to be price appreciation. It's going to be compounding income.
Yeah. It's interesting because Jay Powell, the head of the Federal Reserve, was he was giving a press conference on June 24th, and he said essentially that the central bank should keep interest rates steady for now, citing inflation risks, which you just mentioned. There's still kind of a risk of inflation. So there still remains this heightened level of uncertainty, but yet risk assets continue to perform well. So why do you think that's happening?
I tell you, it's been one of these, I would say, I hate to say the word mistakes, but it is.
Yeah.
When heading into this year, we had all this heightened level of uncertainty, right? And this uncertainty occurred the first 4 months of the year. The worst thing for an investor to do was stay in cash, was to stay sidelined.
Especially with rates as they were moving.
And you would think that, wow, with this uncertainty, what, I'm better off in cash, I'm not going to. And actually, that's not been the case.
That would have been a big mistake.
Yeah, not only have risk assets done incredibly well on the fixed income side, right, but high yield, say, has outperformed investment-grade corporates, right? So you've actually had lower credit quality do well, right? And even with all this uncertainty, right, you've had spreads compress really back into, not the tights that we saw in February, but still levels that are still very tight. And the investor demand that we've seen has been, there's a level that when these investors are recognizing a certain yield level that they realize is a large cushion and a larger compounding income, they come right in. So with all this volatility, with all this uncertainty, we're still seeing this sort of risk assets do incredibly well.
Yeah. Well, back to Jay Powell for a second. And in that testimony he gave to Congress on the 24th and 25th of June, what did you pull away from some of the most key points that he made that really resonated with you and your coverage space here in CIO?
I think that we've had this, and you're always going to have the rhetoric, right? I mean, first you started with the June FOMC meeting where the Q&A was felt a little bit hawkish. The market was only pricing an 8% probability that they would cut in July. all of a sudden you have, things like, whether it's Fed officials, bank officials starting talking about these potential, we should open the door to a July cut, and the probability of a cut moves from 8% to 25%.
Right.
Now, I think that Powell sort of, had the ability to push back on that a little bit, as did other Fed members, besides Waller. So I think it's important to note that you're still going to have this volatility in the short term in that short end, but most of the interest rate risk that we feel that's going to happen or could happen has to do with the deficit and the bill. And even though we don't believe that necessarily we've seen the low, because we are looking for that 4% at the end of the year, you could move up higher, right? Especially since you've moved so quickly on down to 428, which we just saw over the past week. So, our expectation is the Fed does cut at the end of the year, maybe two cuts, in the fall. But our expectation is that inflation is going to remain a bit elevated for a period of time, then move into that disinflation trend that we had thought would occur.
Here's the question that I want to ask you as we're sort of wrapping up, and I always want to end it with where that you find the most opportunities right now in the space. But before I even ask that part of it, there's so much that's going on right now. Obviously, you discussed what's happening with the Fed. There's still some uncertainty there. You've got geopolitical news dominating the headlines, which could impact oil prices going forward. We've also got the budget bill that has yet at this time not been passed. There's a lot going back and forth in the House and Senate. So given all of that and the fact that we don't know where we're going for the most part, where do you see the best opportunity right now in fixed income for investors who are looking for quality and are looking for some security?
Yeah, listen, there's no question that the volatility in the yield curve is still going to occur. We believe the yield curve steeper, meaning that short end comes down as the Fed cuts, which we do believe that they will.
Right. And that's what you would call a normal yield curve.
That's exactly right. So it's one of these things, we were inverted for 2 years, now we're just kind of normalizing back to upward sloping, right? So that's a steeper curve. We think it becomes more upward sloped.
Right.
So when it comes to the oil, as you know, we saw shot up a little bit. We went back down to the 60s in Brent. There is a correlation between oil and, say, 5-year Treasury yields, but it's not our expectation by the end of the year that oil is going to end higher. It's actually probably going to end most likely in the 60s. So one of the things that we look at in terms of where to be, that we still like that intermediate part because we do believe the Fed cuts.
Yeah.
The opportunistically are those, what I think has shifted is what I mentioned before, is that the comfort level, although we have still unknowns, that the left tail risk has moved lower, and also too the realization of how much investors left on the table by being invested in cash during that time of volatility. Sectors such as municipals, which have had really a tough time the first half of the year, we think will do well in the second half. Preferreds might do well in the second half as well. We're still really leaning towards that higher quality, IG corporates, agency MBS. But those sectors that have lagged, especially the higher quality, we think will actually end up, turning around the second half of the year.
Right, and you still have a neutral view on the high yield part of the market, correct?
We do. We have a neutral view on high yield simply because, in the first part of the year, we had a preference to equity. Right. And like we always say, you need to watch your correlations. Right, and that was a big part of it. So high yield, we don't think will fall off a cliff, but we do think it's a bit tight here, and we do think the entry point might be a little bit better a couple months from now.
And still feel strongly about mortgage-backed securities?
Well, MBS we still like very much. I mean, there's no question they've lagged investment-grade corporates, but they are quasi-government guaranteed. We do believe that the housing market, the mortgage rate, is a spotlight to the administration, so we expect spreads to tighten in the second half of the year. Really, given the fact that we're seeing this, or expect to see, deregulation, which hopefully will increase, bank demand.
Right, and some recent economic data is showing that house prices are slowly starting to cool.
And the mortgage rate went to lowest since May, which is still high, but it's on the right path.
That's right, comparatively, of course, but not where it was recently. Anyway, Leslie, thank you as always. Love to have you here. Good to see you.
Thank you.
Great. Leslie Falconio from the Chief Investment Office. And for more information on everything coming out of CIO and Leslie and her team, make sure you're visiting ubs.com/views. That's our Insights website. Plus, UBS is on social media. We're on LinkedIn, Facebook, and Instagram. Plus, you can check out our Instagram channel at UBS Trending. Lots of great studios content there for you to watch and follow, of course. And as always, if you have any questions about what Leslie and I spoke about today regarding your portfolio, make sure you're talking with your financial advisor. Until next time, I'm Anthony Pastore. We wish you a great rest of your day, and remember to keep your eyes on what's trending. See you soon, everybody.